Something strange is happening in this market. It doesn't matter if growth slows or prices run hot. The stress always shows up in the same place. Not headlines, not stocks. The plumbing, funding, collateral, settlement. The stuff nobody watches, until it's the only thing that matters. Markets don't usually break with a crash. They start with a vibration, like driving when the steering wheel suddenly shakes. That's how regime changes begin, not with sirens, with tremors. Here's the part most people miss. Fear is emotional. Funding is mechanical. Fear makes people want to sell. Funding forces people to sell. And when funding tightens, nobody sells their worst assets. They sell their most liquid ones. That's why you can see stocks falling. And while bond yields rise, sounds backward. But bonds aren't just investments anymore. They're collateral. When margin calls hit, bonds get dumped for cash. That's deleveraging. And deleveraging snaps fast. We're already seeing pressure build. Consumer delinquencies are creeping higher. Debt loads are heavy everywhere. The cushion is thinner. That doesn't mean collapse tomorrow. It means fragility. And fragile systems transmit shocks faster. Look overseas for a second. Japan, the most controlled bond market on earth, is starting to wobble. When yields rise and currencies weaken, central banks face an ugly choice: defend the bond market or defend the currency. You usually can't save both without printing. Now zoom back to the US. Treasuries are the collateral base for global finance. So when stress rises worldwide, everyone sells treasuries to get dollars. Not because they hate America, because they need cash. That's how you get fear and rising yields at the same time. That's the loop. Higher yields, tighter conditions. Tighter conditions, slower growth. Slower growth, bigger deficits. Bigger deficits, more bond issuance. More issuance, higher yields round and round. Meanwhile, central banks keep buying gold, not for charts, for optionality. Gold doesn't depend on another government's promise. That tells you how the world is thinking. This isn't about predicting the exact spark. Bond panic, currency stress, supply shock. Doesn't matter. In a debt-heavy system, the path of least resistance is usually save the markets in nominal terms and let purchasing power absorb the damage, slowly, then suddenly. So here's the real takeaway. Don't build a life that depends on perfect timing. Build resilience, stable cash flow, low leverage, diversification by risk, not by ticker, and the discipline to rebalance instead of react. Because the edge isn't predicting crashes. The edge is not being forced to sell when everyone else is. That's where tomorrow's headlines are being written today.